Hello, fellow business owners or number crunchers or whatever your role may be that you decided that this might be an intriguing topic for you to embark on. Today we're going to be talking about a common issue that we see, which is what do we do in our bookkeeping with transactions that were made from a business account but that aren't actually a business expense. So what I'm really specifically talking about here is, let's say you're a business owner and you go to the store and you make a purchase and accidentally use the wrong credit card or the wrong debit card, and you wind up buying something for personal use using your business account. Or, as it sometimes happens, when businesses are first getting started, and maybe there hasn't been time to set up a business account, or it just doesn't seem like there's a need for it yet, business owners will kind of commingle their funds, and they will just kind of make business and personal purchases out of the same account. So we have seen a couple of different ways that people have handled this over the years, and I have to give business owners credit because if there's one thing that they are, it's imaginative and creative when it comes to problems that they're not sure how to solve. So we've seen many different solutions, but the most common one that we see is that they will tend to just exclude the transactions altogether from their bookkeeping system or their bookkeeping software, probably making the logical conclusion that it doesn't have anything to do with business, so we don't have to record it. Unfortunately, that is a myth, and the fact is that you really do want to have those recorded because in order for your financial statements to have any level of integrity, which means that the person looking at them can trust and know that the numbers are accurate and that they weren't just made up, is by tying numbers back to a verifiable source, like a bank statement, a loan statement, a credit card statement, etc. This process is called tying out the balance sheet, basically, and it's confirming that the numbers do match to some other source, like a bank account or something like that. So when you exclude these purchases, there's no way that you can actually complete a reconciliation. So what I'm going to show you today is how you can include those transactions on your books and continue to have the integrity of your books as they should be. Also to encourage you not to do this, I realize it happens occasionally by accident, and that's, one thing, but I would encourage you not to make this a regular habit and to try to avoid those mistakes as much as possible, because realistically, if you are anything other than a sole proprietor, you want to make sure that the whole purpose of creating an LLC or an S Corp or anything like that is basically to protect your personal assets and to keep your personal assets separate from your business assets. But when you start to commingle, and I have a blog post about this as well, when you start to commingle and you're making personal purchases out of your business account, it's almost the same thing as allowing your employees to make personal purchases using your business card, which most employers I know wouldn't do. And then what you're saying is the business and I are one and the same, therefore our assets are one and the same. So if you're going to sue me, or if I'm claiming bankruptcy or whatever, you now have permission to go after my personal assets because there is no separation between me and this business. So you want to avoid that definitely. So I'm going to show you today how you can do that by recording those purchases. And I think the most important thing is, obviously, as a business owner, you can take money out of your business, absolutely. But the proper way to do that is to pay yourself from the business directly. So transferring funds from the business account to your personal account, or writing yourself a check and then putting it into your personal account, and then going and making your personal purchases. Don't make them directly from the business account to the vendor that you're buying things from, like your groceries or a school field trip or whatever it might be. So again, as I said in my blog post, enough of my soapbox, let's get to the solution. So the first thing that you're going to want to do, if you have personal purchases that you've made and you want to record them on your books, as you should, you want to make sure that you have the proper equity accounts set up to be able to do that. So an equity account is basically a balance sheet account, and I'm going to pull up a balance sheet here so that I can demonstrate what I'm talking about. So in your business, one of your financial statements that are most commonly used is the balance sheet. And what this is a record as of any point in time. So this one is as of October 26th today. And this is a sample company, by the way. This isn't anyone's real set of books, but I'm using QuickBooks Online, but these principles can work really in any accounting software. The navigation might be different, but the principles will be the same. So hopefully you'll be able to follow along and do the same in your software if you're not using QuickBooks Online. So on the balance sheet, we have assets, which are things you own. We have liabilities, which are things you owe to somebody. And then what's left over is equity. So think of it as a home mortgage. The asset is the value of the home, and the liability is the mortgage that the principal of the mortgage that you still owe on the home, and the equity is the difference between the two. So the same thing goes in your business. So we have equity accounts down here, and in this case, we just have opening balance equity. I'm not even going to get into what that is right now. We have retained earnings, which is basically money that was profit from prior years that was not dispersed. It was left in the company, so that gets moved into retained earnings. Again, I'm not getting into details with that. And then we have the income of the business year to date. So we're going to want to add an account because in this case, we don't have the accounts we need in order to properly record these purchases. We're going to add an account called owner's distribution and an account called owner's contribution. These things can be called so many different things. They can be called shareholder distribution, owner's draw, member contribution, member distribution, lots of different names. The idea is just make it something you understand what it means. You can always fix it later or explain to your accountant what it means if it doesn't match their terminology. But for all intents and purposes, it's money that the owner has either taken out of the business or contributed to the business. So in QuickBooks Online, I'm going to go to my chart of accounts. There's a couple ways to get there, but I'm just going to go through the gear wheel here because my picture is covering up the menu item over there on the left. And we're going to create a new equity account. And this equity, so a type is equity. And then down here, if you're using QuickBooks Online, it takes it a step further on detail type. I really don't pay any attention to these. I always just go for the other category if there is one, which I don't think there is here. But in this case, it's going to be owner's equity. So I'm going to pick owner's equity because this has to do with the owner taking money out or putting money in. And then here I'm going to call this owner's draw. And then I'm going to do save and new, and I'm going to create one for owner's contribution. Because the same thing goes for if you purchase something with your personal account, but it was for the business. You want to record that expense on the books because you want to get credit for it. If it's a tax deductible expense, you want to get credit for it. So then you would record that on your books, and I can maybe throw that in at the end of the video here as a bonus of how you would do that. But let's say you purchase some office supplies and you use your personal card and you want to record that on here. That would be recorded as a debit to the office supplies expense account, which is increasing your expense, and then a credit to owner's contribution, which basically says the owner paid for these items, even though they were a business expense. So we have our two accounts created now. That was step 1 and 2 in my blog post if you're following along, and I have that linked down below in the video. So now we're on to step number 3. We want to record the purchase as we would any other purchase in our accounting software. So let's say that you used your checking account, and we're going to create a new expense. And let's say it went to, and I'm just going to use the vendors that are in here, but let's say it was Chin's Gas and Oil. And this was actually a personal purchase that had nothing to do with the business. It doesn't have to do with any automobile that you're tracking in the business or anything like that. This was, let's say it was gas for your lawnmower at home. And you put it on your MasterCard. So we're going to put this not to automobile fuel because it's not really a business expense. So we're not going to put it to a business expense category. We're going to put it to owner's draw because it's money that you took out of the business for personal use. And then you can just put in here, whatever memo. Accidentally used business card to purchase gas for lawnmower. Lawnmower, that was fun. Mower, not more. 52.56. Okay, so you're going to save and close that now. So what essentially happened is if we go to our balance sheet now, we recorded the charge to the credit card so that when we reconcile the credit card on our books, that charge will show up and we'll have it in there. But it also shows now that we have $52.56 that the owner took from the business for something for personal use. So let me just show you here. If I go to reconcile for the credit card, and let's just throw in any old thing here. We'll see that purchase, here's the 52.56. Actually, that's not even it. It was 10.26. Here it is right here. So now it shows up for us so that we can properly check that transaction off and match it to the credit card statement. So that takes care of item number 3. Now, you could choose to reimburse the company for this purchase. So you accidentally used the card, you didn't mean to, you want to put those funds back into the company. So in order to do that, and this is going to be kind of similar to if you purchased, well, no, it's not. So let's just say you want to reimburse this Chin's gas and oil transaction. So what you're going to do is maybe write a check to your bank account, or maybe you're going to do a transfer or whatever it is, but you're going to replace the funds back into your business. So let's say you're going to deposit it. We're going to do a bank deposit, and we can't put it back to our credit card, obviously. Well, you could technically, I guess you could make a payment to the credit card directly from your checkbook, but let's just say you're going to put it in your checking account. And then you're going to come down here where you manually add funds, because it's not a payment received from a customer or anything like that. It's not going to be up here in the items to check off. It's going to be a manual item received from, let's just, you put your name in there. And then we're going to say, because you're replacing something that you already put to owner's draw, rather than putting this to owner's contribution, which you could do, and that would be fine too, I'm actually going to put this directly to owner's draw so that it just washes itself out within the same account. So I'm going to put this to owner's draw to offset what I've already put in there. And I put the 52.56, and then I would save and close that transaction. So now if I go to my balance sheet, my owner's draw is 0. And if I open up the detail of that, I can see that I had an expense, but then I replaced the expense. So now it's $0. But now let's say, and this is kind of the bonus part of it, let's say that you want to, that you purchased office supplies and you used your personal card and you want to record that expense on the books. That you're actually going to have to do with a journal entry. That is a little more advanced. I don't usually like teaching people, how to do journal entries, but if you have this video, you're going to know how to do it right. So I feel a little bit more comfortable with that. So what you would do is you would find where you can make journal entries in your accounting software. In QuickBooks Online, it's under the plus button. And you would debit, because a debit increases an expense account. So let's say office supplies or office expenses. Let's say you spent $15, and then you can just put notebooks purchased with owner funds for business use. And then you would put here owner contribution, because you contributed that $15 to the business. Now, again, you could reimburse yourself if you wanted to. We've gotten the initial purchase on here, but let's say now you want to reimburse yourself for that purchase. Then at whichever point you decide to reimburse yourself, you would maybe write yourself a check or transfer money or whatever you're going to do to get those funds back. You would make the, payee yourself, whoever that is. Let's just say Pam Sites. It's going to come from the checking account. Now, you don't put it to legal and professional fees. You don't put it to office expenses, even though that's what you initially bought. You already recorded your expense to office expenses. So if you were to record this to office expenses now, you would actually double that expense, and you don't want to do that. This needs to offset the owner contribution, because you're no longer contributing the funds, you're taking them back. So you're going to code this to owner's contribution for the $15. And then here you could put reimbursing for office supplies purchased. Now, that's kind of the long way. The way I just showed you with the journal entry would mainly be used if you're not planning on reimbursing yourself for those office expenses. Obviously, the quicker and cleaner way to do this would be to just reimburse yourself immediately for that purchase. So you went to the store, you bought the office supplies, just reimburse yourself right away. And it's easier that way. The journal entry, like I said, is more like if you're not planning on reimbursing yourself, you're just going to let that one slide, but you do want to record the expense. If you are planning on reimbursing yourself, then just go ahead and put the expense in right away, put it to yourself. Now, in this case, you would classify it to office expense because it's the only way it's going to get, recorded in this case. Hopefully I didn't confuse you too much with that last piece. In fact, I might just take that right out of the video altogether. So that pretty much sums up how you handle personal purchases made from business accounts and or purchases made from personal funds for business use. And if you enjoyed this video and found it helpful, feel free to visit our website and sign up for our newsletter where you can receive monthly tips like this directly to your inbox. And hopefully you can get some more useful information and have one very clean set of books and a very healthy business.